So, new multifamily development has been a recent conversation with trying to get rid of all the rising interest rates, go under construction and then deal with it on the back end when you come out of this, when rates go back down. What are you seeing, James?
Yeah, I mean, a lot of people, when cap rates compressed, they just, it was hard for them to justify these lower cap rates on some of these B and C class properties. So they were just like, all right, we're going to develop, which was great. Some people got sort of a low basis on the development, but then COVID hit, construction costs rose, and now you might be delivering into a soft market. And so a lot of developers, you really have two options, right? So you can either do a HUD loan, 221D4, or you can do just a recourse bank loan, which is going to be probably 60-65%, and most of those are 3 to 5 years. And so if you do the HUD loan, you've got 35 years, plenty of time, low interest rate. But if you do the bank loan, most of those developers are going to have to refi or sell the asset right at the end of those 3 years. And so we've done HUD loans, we've done bank loans. So just depending on your business plan, reach out to us and we can tell you a little bit more about developing sort of a new Class A property on the multifamily side.
What do you need to qualify for a new HUD loan or a new development loan?
Yeah, so on these loans, they're looking for similar net worth and liquidity, right? So net worth equal to or greater than the loan amount. They probably want more than 10%. If you want to get 15-20% of the loan amount in liquidity would be good. And then they're wanting to see the partners have construction experience. They want to look at the contractors you're going to be using, the architect, and then they really also want to look at sort of a market survey as well to figure out, all right, if you build 200 units in this submarket, how fast is it going to get absorbed, and what rents can you get on that type of property?